Welcome to Expanding Frontiers from Pearl Quest. I'm Kathryn Wilkens. Here, we explore the evolving edge of investing, data, and the frameworks that help us make sense of it. Okay, I'm pleased to introduce our guest, Dr. Adam Link. He's the founder of Fireweed Capital, an insurance agency, and is also an investment advisor representative of Portfolio Medics. He's the author of 2 books challenging conventional assumptions about portfolio construction and financial advice. In Better Than Average, A Realist's Guide to Investing with Purpose, Protection, and Performance, he makes an evidence-based case for moving beyond passive indexing and beyond standard deviation as a risk measure, arguing drawdown risk and dynamic portfolio design deserve a more central place in the advisor's toolkit. In his other book, Index and Regret, Because Your Family Deserves Better Than Average, he extends that argument to retirement income planning and the growing role of liquid alternatives. Adam brings both the practitioner's perspective and the author's discipline to a conversation that is long overdue in mainstream financial advice. Welcome, Adam.
Thank you very much. I'm glad to be here. Thank you for the great intro.
So in your books, you critique average as a standard in investing. For a listener who has never questioned it, how would you make the case that average is not a neutral outcome?
Yeah, that's a great question. So I think when people talk about average, what they have in mind is certain numbers. And one of the most deadly numbers, I actually had this with a prospect today that we were talking about their finance and their retirement plan. And they basically said, on average, the stock market returns 7 to 10% a year. And so they said, so therefore, off my $1 million in the stock market, I can expect $100,000 a year. And on average, right? Yeah, it's the high end of the math, but on average, they're not wrong. Now, the problem with average, though, is that in almost no particular specific year will they get $100,000 in returns off a $1 million portfolio, right? Because you could have a 0% year and a $200,000 return year, and on average, they get $100,000, but in no particular individual year did they actually ever get $100,000, which matters a lot when you're trying to spend $100,000 a year in retirement. So that's my big problem with average is like you are mathematically correct and 100% going to starve.
The phrase purpose, protection, and performance structures your first book. How would you define the relationship among those 3, and does one have to come first?
Yeah. So between purpose, protection, and performance, I think there is a natural progression. Everyone wants money, right? But the reason we want money is very different for each of us. And one of the things I've found is individuals who get a large amount of money, $1 million or more, often end up hitting that benchmark of $1 million saying, well, great, I hit the benchmark, now what? Right? They've been striving their entire life towards $1 million. And so, when you think about purpose, right, that is really why you are trying to get that $1 million in the first place. And many people find if they didn't have a purpose for it, that very quickly the next goalpost becomes 2 million or 5 million or 10 million because there is no purpose. All you're doing is just creating money. And then the next thing is, protection. Because at the end of the day, getting $1 million and then losing $1 million doesn't necessarily leave you fulfilled. And so once you have a purpose for the money that you want, you then want to protect the money that you have because that was the reason for getting that money in the first place, right? And then as people find out very quickly, whatever their original goal was, it's never enough because lifestyle creep happens and your desires to change the world go beyond just what you had originally intended. And so performance really becomes the third thing that once you get there, all of a sudden you go, wow, I need a lot more in almost every case. And, so then you got to figure out, okay, well, now that I've got a purpose for my money and I'm protected from the downside, now we want to start talking about how do we capture as much of the upside as we can so we can continue to drive forward with larger and larger purpose for our money.
That leads to the next question. When you're talking about the downside, Standard deviation still is the dominant risk metric in most client-facing materials. What does it miss, and what would you put in its place?
Yes, standard deviation is a great statistical tool. And I will say, as a statistical tool, standard deviation is really what I look for first when it comes to variance of a portfolio. However, standard deviation is horrible for clients. And the reason for that is no client calls up and says, I'm up 20%. I am so outraged. I am 2.5 standard deviations away from the normal. What are you doing wrong with my portfolio? Right? No one does, because everyone is happy when they're up. Now, the problem is every client, or most clients, are going to call up and say, I'm down 20%. I'm 2.5 standard deviations away from normal. What are you doing with my portfolio? And so really what we want to do is measure the downside deviation risk, because our clients don't care about surprise to the upside, right? What clients actually care about in the real world is surprise to the downside. And it's not even surprise to the downside, but it's just downside in general, right? People don't want to lose. Again, I had another client basically talking about, well, I just don't want to be in the stock market anymore. I just don't want to lose. And the next statement, they were like, well, I can handle ups and downs, and that's fine, but I just don't like the downs. Okay, well, that's great, but that's not how this works. But as it turns out, we do have a measure for that. It's called the Sortino ratio. And I think financial advisors should get a lot better about selecting and optimizing for Sortino ratio, right? Because at the end of the day, even a tight band of standard deviation just means that you're going to go up and down within a small range. But really what we care about is that down, right? Because even if you're only
We'd
going
like some variance on the up.
exactly, yep, yeah, even if you're only going down 3%, you got a very tight standard deviation, you're still going to have clients that call you on 3% down because they think that that's too much, right? So we should start looking at drawdown protection, downside protection primarily.
All right, let's talk about passive investing. Your book argues that passive investing is unresponsive rather than safe. Can you walk us through that distinction for a listener who has been told index funds are the responsible default?
Yes, exactly. So there's a lot of ways to attack this, and I will say you can attack this heavily from a academic standpoint. In academics, we learn about the efficient market hypothesis, right? And basically, the industry has taken this theory of efficient market hypothesis. And for those of you who don't know, basically, it says the more efficient markets are, the less likely there's an arbitrage opportunity due to information asymmetry. However, practitioner literature has taken this to the extreme to say there is no information arbitrage available and markets are perfectly efficient. And that is point blank wrong. We know that academically because you can look at factor analysis and you can find factors that you can trade profitably throughout time, right? So academically, we've already disproven it with an N of 1. But beyond that, the reason that industry research, industry practitioner literature does that is most individual practitioners do not have the equipment necessary to actually generate alpha, right? And so when you are betting against a sophisticated trading desk as an individual in, I'm going to say Des Moines, Iowa, right? You are not going to generate alpha statistically speaking for your clients. So it is best to treat the markets as perfectly efficient and assume that you can't beat the market, right? Now, if you are on Wall Street and you work for Goldman Sachs in a prop trading desk, your job is to beat the market, right?
Mm-hmm.
And you're employed for a reason because beating the market is possible, because an edge is possible. And so you have these two differing viewpoints. Now, which one is talking to the public? What's the person with the small office in Des Moines? And so what they're saying is, well, just invest in the index fund. And so what you have is this split that happened in academia that's now been driven all the way out to passive investing is the only way to invest. And that is demonstratively incorrect because we can see that in Wall Street bank profits, right? And so when I look at that, I say, okay, well, what if we started talking to the public again about this notion of active management, right? And what if we said, well, there is an edge to be found in the markets. Some managers do outperform. Some managers consistently outperform. And so where I look at passive indexing and basically say, I don't think this is really responsible, is I don't think my job as a financial advisor is to say, based on everything we've studied, go to the index funds, because I know that's wrong, right? Maybe
Yeah.
some of your money goes there, but there is an edge to be had. And it's my job as a professional to find you that edge, not to generate it, right? But to find you an edge with a money manager that does.
Yes, there's been a large amount of funds flowing towards index investing, and that in itself can cause an imbalance. Earlier in your book, you talk about sequence of returns risk. I think that's an important concept. Can you define it in plain terms and explain why it's particularly dangerous for investors who are close to retirement?
Yes. So basically, what sequence of returns risk is it's the next step beyond average is not what you experience, right? So if you were to say on average, I get 5% a year, and you take your returns as, let's go 0, 20, and what, 2.5, something like that. We're doing math live here. So for those of you who are math nerds who are
Okay.
better at math than I am, I apologize. I just probably made something that's close to 5, but not quite. But again, the idea here is that if you take a sequence of returns and you order them differently, so for instance, you put the negative returns first before the positive returns, a negative return draws down the principal, and then a positive return grows the principal. But if in the intermediate period you are taking money out of the principal to live, a drawdown initially lowers your principal and that withdrawal lowers your principal. Then another drawdown in the market lowers your principal and a withdrawal lowers the principal. So you have a much lower principal when you start adding back your positive years, right? You know, your positive 2.5, your positive 20, right? And so that is basically what sequence of returns risk is, which is the year in which you retire could be an up year, which is good because you're building principal then taking some down, or it could be a down year, which is bad because you're losing principal and then taking more down. And I can show you mathematically that if you stack negative years early on, you have a much higher likelihood of running out of money over a standard retirement period, right? Whereas if you have positive years early on, you have a much lesser likelihood of running out of money in retirement. And so even though on average I can get you the exact same amount of returns, right, the same percentage return, I can make one portfolio implode and the other one survive simply by adjusting when those negative returns happen. And that is really, as someone nearing retirement, that is like super scary. At least it should be super scary to you, right? Because if you have those bad years up first, you might not have enough money for retirement, right?
Yeah, that's an important concept. So how do you avoid it? How do you avoid those?
Yes. Beat the market. No, I'm kidding. How do you avoid sequence of returns risk, right? So really what you're looking at, you can't avoid sequence of returns risk with money that is in a investment instrument that has variable returns, right? Unless you can predict the future or control the stock market or control the asset class, you are at the whim of the market, right? So what you can do is you can start to separate out your buckets of income in retirement. And this is where I'm going to say the word annuities. Some people have very strong reactions to that word, right? But you can substitute dividends or bonds or whatever you have. But the idea is some of your core money that you need for living every day, you take out of the market so you don't have sequence of returns risk and you put it into an investment class that doesn't experience sequence of return risk, right? Or doesn't as bad. So for instance, you could put it into a bank CD, right? Bank CDs don't lose money. That's the point of that investment, right? They give you a return that is guaranteed. Same thing with annuities, right? Annuities generally don't implode. They give you a guaranteed return that is backed by a third party. And so you don't have sequence of return risk there in that stream of money, right? And that's then the stream of money you use for your essential expenses, whereas all your additional, legacy spending or your stretch spending comes from something where there is sequence of return risk. Because again, the higher the risks you bear, the higher the reward. And so if you have sequence of return risk, you should be compensated for that. And so your returns should be higher on this pot of money. We just want to control when we take that money out.
That's exactly the first time I saw that term, sequence of returns risk, was in the context of reaching that decumulation phase and using annuities to help with that. So you also build smarter portfolios. You write about dynamic portfolio design as an alternative to static allocation. So what does that dynamic mean in practice, and how does it change the advisor's role?
Yes, this is something that we actually do a lot at Portfolio Medics. It is one of the reasons I'm an IAR there, is for our investment management philosophy. And we basically believe that a investment advisor can and should have the ability to go to cash as a defensive position. And this is unlike what many large financial advisory firms do, which is basically put you into the market, leave you invested, and when the market goes down, say, well, just wait a little bit. Very infrequently are advisors actually rotating to cash with their client base when they see signals in the market that holding more cash may be better than not, right? So one of the things we do is we actually do view cash as a position, as a defensive position in our portfolio, whereas, quite frankly, a lot of advisors will sit there and have a minimum cash amount and then an automatic invest program for all the excess cash, right? And if you don't believe me, literally call up whoever your current financial advisor is and put $10,000 in and say, is this going to get automatically invested? 99% of them will say, well, yes, of course it will. It's going to get swept into your default portfolio allocation because we shouldn't hold cash, right? Well, what if holding cash is the right position because there's nothing good in the market? And so that's where we design dynamic portfolios, right? Where we will say, okay, well, there's nothing good in the market according to this algorithmic trading strategy. We're going to hold cash as a defensive position by design. And so the other day, we're recording this here mid-July. The other day I logged in and some of our portfolios had 50% cash, right? And it's hilarious when you look at that because you plug that into AI right now. And this is why, again, we can talk about AI all day, but this is why AI is still catching up to how you actually invest. Is AI literally took a look at that and said, you're holding too much cash, invest. And I said, no, I am invested. Cash is a position. And it was like, what? You can't do that. You can't hold that much cash. It's like, well, yes, right? That's dynamic portfolios. It's dynamic allocation. And the reason most people don't do this is it's a lot of work. It's a lot of work to actually look at the market every day and every week and have multiple strategies and algorithms and all that. So yeah, that's kind of how I look at, again, I think there's a higher calling that financial advisors could hold themselves to basically say, look, my job as a professional isn't just to sweep you into the market and say, hold on, right? I should be finding someone who manages money and actually manages the money, right?
Right. So we have a little bit of a theme. A previous guest on Expanding Frontiers founded an index built on insider ownership, with the idea being that founders with significant stakes in their own companies behave differently than those without. Your work touches on a parallel idea at the advisor level. How do you think about skin in the game as it applies to the people managing other people's money? Sort of what you were just getting at. But we could also talk about the hidden costs of free advice.
Yeah. One of the things that I love talking with financial advisors about is how are you invested compared to your clients? I think there's two very important things that question discovers. The first question is this financial advisor speaking from theory or experience? Now, I want to be very clear here. You don't have to be rich to be a financial advisor. But I also think as an advisor, you should be similar in economic status to your clients. If you only have $10,000 to your name and you're trying to advise someone with $10 million, you have a very different mindset than your client does, right? And so if you are going to be a good advisor to high net worth individuals, I think you should have walked part of their path in some way, shape, or form, whether that means doing your own business or being around enough advisory for other businesses to know what you're talking about, or being around enough wealthy people to have stories, or being wealthy yourself, right? But skin in the game really means you've got experience with that particular person you're serving. The second thing it figures out is, are you invested like your client? Because if you are not invested in the same thing you are recommending to your clients, you need to ask yourself why. And the worst possible answer is because I don't believe in what I'm selling, in which case, go find a new career. And I feel very strongly about that, right? As a financial professional myself, right, I have a similar size portfolio to my clients, right? When I talk to people about how to move money, I have moved those sums of money myself, both for myself and for my clients. That gives me experience and credibility. And the second thing is I move it the same way I'm telling my clients to, right? I've got a great story. I lost a whole ton of money in real estate, which basically tells you how far I got into real estate, that I could lose a whole ton of money, right? But when I talk to people who are real estate investors now, they're like, well, I did this and this. And I'm like, yeah, me too, man. Right? Like I made a whole ton of money in real estate. Hey, so did I. I talked to a guy who's like, yeah, I've lost a whole bunch of money in real estate. In fact, the guy's going through investigation with the FBI. I was like, hey, me too. I also lost money to fraud in real estate. He's going through investigation with the FBI, right? But again, it's, do I actually invest in what I talk about? And I do, right? And so I've got those stories, positive and negative. But I really do feel strongly that advisors, you shouldn't be sitting there with no money not invested the way your clients are, because you're doing your clients a disservice, right? You should have enough stories and wealth to be able to manage your own money before you manage other people's money. And you should have the same investments that your clients do, commiserate with your risk tolerance, because you should be buying what you're selling. You should take your own advice before you try to help somebody else.
Good. All right, let's move on to the future of financial advice. You close your first book, or one of the books, with a chapter on smarter future for financial advice. What does that future look like, and how far away do you think we are from it?
Yes. So AI has been amazing when it comes to generalizing basic financial advice. And I love that. It's super awesome. It's just like the robo advisors, 10 years ago. They're not putting any of us out of business. AI is not going to put you out of business anytime soon. If it is, you're not complex enough in what you're doing, because the future of financial advice here, I think, is going to be a world wherein we get actually more human, because the less human algorithmic stuff, the machine calculations, that can all be done by AI, right? But AI today is a sycophantic model. It will always tell you you're right. And one of the things that I bring as an advisor is the ability to look you in the eye and say, that's wrong. That is not a good idea, right? And part of what my clients pay me for is for me to look them in the eye and say, that is wrong. I know that's what I pay my advisors for, because I don't need a bunch of yes men. I need someone to say, you got that one wrong. Here's how I do it differently, right? The other thing, and I'll leave you with a very concrete example of where I think the future of financial advice is hopefully going. I envision a world wherein all financial advisors look at Social Security as a bond and a bond holding. Stop putting your retirees in bond-heavy portfolios. When you capitalize the amount of Social Security coming in, which is a bond investment, you will find your fixed income sleeve is heavily overweighted. If you're a financial advisor listening to this, you got retirees in a 60-40 portfolio, stop it. Capitalize their Social Security holdings, rerun your analysis on their portfolio, and up the equity position. That is, I feel so strongly about that. I may go get a second doctorate specifically writing about that topic because it blows my mind how often people are so risk adverse in their retiree portfolios because they don't capitalize Social Security. There you go. That is the future. Concrete, one little thing we're going to change.
I know we have a couple more minutes left, not many. I sort of jumped to the future, which is kind of closing up, but I think we skipped over your views on liquid alternatives.
Yes. Okay. So I read this great book on alternative investing, and it got me thinking a lot about the way that we as financial advisors typically build portfolios. And this is an area that I would like to see the profession mature in. And it's difficult because the current law, if you start recommending alternatives, holds you to a very high standard, a fiduciary standard. And there are court cases that say simply reading a sponsor's materials and saying it looks good enough is not actually good enough. You have to do a significant due diligence beyond that. But the legal caveats aside, there's more than just stocks and bonds out there. And we hear this all the time. People that are doing real estate, that are doing private equity, that are doing venture capital, right? There are other things called liquid alternatives, which are other investment contracts that are liquid So you can get in and out of them. They're not, they don't have a lockup period, but they, produce higher returns. Private credit being one of them, where there is a quarterly withdrawal cadence. Now, again, private credit has its own issues, but the general call here behind that liquid alternative side is there are assets that allow you to increase return with no significant increase in risk, again, statistically speaking, and you can make a better portfolio out of that. And if you can, right, we all know our efficiency frontier line, right? If you can find me a portfolio that returns more money for the same amount of risk, that is the efficiency frontier. And so that's kind of my call to financial advisors is, take a look at what your efficient frontier is made out of, because you are missing assets that actually could give your clients perhaps a better return for the same amount of risk. And again, calling the profession to a higher standard, I think you owe it to your clients then to do some due diligence, right? Like, you got to get your hands dirty. It kind of sucks, and you you got to do some work, right? But you shouldn't be golfing on a 1% fee, So dig into some alternative investments and get a sense, and see if there isn't something out there that you've been missing in your practice. Because again, I think there's a lot more we can do as a profession here on the investment management side.
Great. I'm glad we got that in, because we're on the same page with alternative investments. We are just about out of time, so I want to thank you very much, and hopefully I can have you back on when we're not so crunched for time in the future.
I would love that. Thank you so much. This has been great chatting.
All right. Thank you. Take care. Bye-bye. This has been Expanding Frontiers, a Pearl Quest podcast. Stay open to what reveals itself. Until next time.